Today we're tackling a really fascinating area, crypto lending. You've shared some great sources with us, and our mission here is to unpack the core opportunities and maybe more importantly, the notable risks involved. Think of this as a way to get up to speed quickly on this whole space.
Absolutely. It's definitely an area with a lot of innovation, but yeah, also significant complexity. You can easily trip people up. Our goal is to help you navigate these materials, sort of connect the dots on what really matters.
Okay, great. Let's dig in then, starting with the opportunities. The thing that seems to grab headlines based on the sources is this potential for earning passive income. Those interest rates look pretty high.
They certainly do. I mean, what's immediately striking is lenders seeing rates, often 8% to over 10% APY just for depositing their crypto. And that's, well, it's significantly higher than what you typically find in a traditional savings account. It really highlights the demand for capital in this crypto ecosystem.
Yeah, 10% APY definitely gets your attention. Is that purely because it's riskier, or is there something else making those rates possible?
It's a mix. There's definitely a risk premium baked in, but fundamentally it's supply and demand. You have borrowers needing funds quickly, maybe for trading, arbitrage, things like that, and lenders willing to supply that crypto capital for a higher return in, well, a less regulated environment.
Okay, that makes sense. And another big draw mentioned is getting liquidity without selling your crypto.
Yeah.
Getting cash or stablecoins against your holdings.
Exactly. And this is a really key point.
Why is that so important?
Think about how you'd usually get funds. You sell an asset, right? Which, depending on where you live, can immediately trigger capital gains tax. Crypto lending offers this alternative path. You leverage your assets, get the cash you need, but you keep holding your crypto, potentially avoiding that immediate tax hit.
Right, so you maintain your position.
Yeah.
And it seems these platforms are, well, pretty easy to access compared to traditional loans. The sources talk about no credit checks.
Yeah, that's a huge difference. No traditional credit checks means it's open to a much wider group of people, maybe folks with limited credit history, or none at all. Plus, they're generally fast, like minutes, not weeks, and borderless.
I think one source mentioned a small business owner somewhere in a developing country getting funds for inventory in like a day, something impossible through normal channels.
That's a perfect example. It really speaks to the financial inclusion aspect. It can democratize access to capital in ways traditional finance often doesn't.
So beyond the rates and the liquidity, we've got accessibility. The sources also touch on transparency because of blockchain flexible terms, even early withdrawal options sometimes. And for people already holding crypto, it's another way to maybe diversify income streams, right? Put those assets to work instead of just letting them sit there.
Precisely. Making idle assets productive is a big part of the appeal.
Okay, so the allure is definitely strong. High returns, quick cash, accessibility. It sounds almost too good to be true sometimes. Which brings us to the flip side, the reality check. Let's talk about the risks, because the sources are pretty clear these exist.
Yeah.
What's the biggest one that jumps out?
Yeah, the risks are absolutely critical to understand. And the number one, without a doubt, is volatility risk. Crypto prices, as we know, can swing wildly. So the collateral you put up, if its price tanks, you could face a margin call.
Meaning you have to add more collateral?
Right. Or worse, face forced liquidation. That means the platform automatically sells your collateral, maybe at a really bad price, to cover the loan. You can lose a lot.
And it's not just that prices can drop, is it? There's something about the speed.
Exactly. That's a crucial layer some sources highlight. It's not like a traditional margin call where you might get some time, maybe days, to react. In crypto, especially with automated systems, a sharp drop can trigger liquidation almost instantly, minutes, sometimes seconds. It's like accelerated volatility risk. You might not even have time to react before your collateral's gone.
Wow, okay. Accelerated volatility risk. That's sobering. And then there's the platform itself, right? Counterparty risk?
Yes, absolutely. This industry is still, finding its regulatory footing in many places. That leaves platforms potentially vulnerable to hacks, to mismanagement, even insolvency. The sources mention big names like Celsius or BlockFi. That collapsed. It shows even major players aren't immune.
Right. Those failures sent shockwaves.
They did. And it underscores the contrast with traditional finance, which, for all its flaws, has layers of regulation, deposit insurance in some cases, things like that. With crypto lending, the legal landscape is still evolving. A new rule tomorrow could drastically change how a platform operates, or if you can even access it. That uncertainty is a risk factor in itself.
And beyond market risk and platform risk, there's just the complexity of it all, understanding the terms, the liquidation triggers.
Definitely. These aren't always simple products. You really need to understand the loan-to-value ratios, the liquidation thresholds, the fees, and especially with DeFi platforms, it all runs on smart contracts. These are just bits of code.
Code that can have bugs.
Exactly. Bugs or vulnerabilities that hackers can exploit. We've seen cases where flaws in the code led to millions being drained from lending pools. So tech risk is very real.
Okay. And finally, you mentioned taxes earlier regarding avoiding them by borrowing, but there are tax risks too.
Yes. While taking the loan usually isn't taxable, getting liquidated is often a taxable event because your crypto is being sold. And earning interest income generally is taxable too. The rules can be complex, they vary hugely by jurisdiction, and frankly are still unclear in many places. That's another layer of complexity to manage.
Right. Okay, so summing this all up then. For you, the listener, try and make sense of this. What's the bottom line? We've seen crypto lending can be, well, a really powerful tool, passive income, quick liquidity, accessible.
Absolutely. It offered the things traditional finance often can't match in terms of speed and yield. But, and this is a huge but, it comes with very unique, very significant risks. That sharp volatility, the platform risk, the regulatory uncertainty we talked about.
So the key takeaway really hammered home in all the sources you shared seems to be do your homework. Due diligence, understanding the specific platform, managing your risk exposure, knowing the terms inside out. It's not just recommended, it's essential.
Couldn't agree more. It's absolutely essential before you even consider putting funds into one of these platforms.
Well, we hope this deep dive into your sources has helped cut through some of the noise and given you a solid grounding in crypto lending. As you explore further, keep asking those questions. How do these opportunities really stack up against those risks for you? Thanks for sharing the materials for this deep dive.